All right, welcome back to Class 2 of the Advanced Trading Strategies Risky Business. Again, this is Alfonso Esposito, and I am the writer and instructor of this course. And so before we jump into Class 2, let's just briefly talk about some of the salient points that we covered in Class 1. Again, the whole Class 1's premise was to start to bridge that gap between the professional trader and the amateur trader or the gambler. And I introduced you to the R trading system and the importance of that. And also started to share with you how the steps are to trade R's. And I'm going to touch a little bit about that in a few slides here. But again, the one thing that I really wanted to cover, because I don't have it in a slide, is how I started to stress the importance of how risk management is to thinking about your trading, because the difference between the 10% who are consistently pulling profits from the market and everybody else is that they truly think differently. And so everything that I teach, even though there's a lot of content and good material in which to use, always be taking it with the framework of how you're thinking about your trading and setting yourself up to win. And so let's talk about, again, the class schedule. We covered risk management in Class 1. Tonight, or this second class, we're going to be discussing using R with options, because one thing that I found is that many of you, many Tradesmart University students, use options to trade rather than stock, trade directionally, puts and calls. And so Josh actually helped me with this chapter in coming up with the way to make your options directional trades consistent and specific so that you're always risking the same amount for each trade. And so you guys are going to love that formula that I share with you soon. And then the next class, we're going to cover trade management, and then we're going to put it all together in Class 4. And so again, this class, using options with the R system. So specifically, what we're going to cover in this Class 2, brief review of Class 1, trading the R's using options, the trader progression and the power of the compounding R. Remember, I left you with that good news, bad news after the last one. And so let's get right to the review. So again, the primary outcome of this class, to bridge that gap between the professional trader, the 10% that consistently pull profits from the market, and the rest of us, well, I'm in that 10%, but the rest of the traders who just are amateurs, gamblers. And so in Class 1, we discovered how professional traders view risk management. Remember, it's a way of thinking more than anything else. It's a way of thinking. It's a way to set your trading up so that you're focusing on consistency, acquiring skill, and trading in probabilities. So this is a visual that I did not show you in Class 1. But as traders, we're somewhat visual because we're looking at charts all the time. And so my belief is that most of us as traders visually put things together. And so imagine we have this vault, and inside the vault are these stacks of money. And so each stack of money would represent an R, or how much you're willing to risk on a trade. And then you put that risk unit into the marketplace. And if the trade goes in your intended direction, you would anticipate that you would have a likelihood at least to make 3 return units on that one risk unit to put back in the vault, and then you just continue that cycle again and again. Okay, so I thought that was a nice visual to share. And remember this example from Starbucks. So again, just a quick review. If somebody has a $5,000 account, the maximum that they would risk on each trade would be 2% or $100. In this example, the entry $55, the stop $52.50, and the target $62. And so your R is 100, your stop is $2.50, so you would be able to purchase 40 shares. Now, this slide, and this will be the last review slide, then we're going to get right into the options stuff. This slide, as I said, is the money slide, because if you forgot everything else that I told you in risky business and just remembered this slide, your trading results will change forever. Remember, you do not want to be the inconsistent R trader, risking different amounts for each trade. And mostly that happens because traders have a tendency, a propensity to risk or trade or change their R unit based on how their last trade did. Again, you have to think in probabilities and in consistency. The stock market is random. There are so many unknown variables. And so the way to profit in a random environment is to be consistent, to set yourself up from a probability standpoint to win. So be the consistent R trader, not the inconsistent.